Well, thank you for joining us today. I'm so happy that you're here and making time for this. My name is Talia White, and I am the Deputy Director for the Library Foundation, and look forward to getting to know you. A couple of housekeeping items for you. One, we have a Q&A button at the bottom of your screen, so feel free if you have questions for Nick to add them there, and then at the end of his presentation, I will ask questions as they arise. The other thing is we do have a survey. We'd love your input. So we have a brief survey at the end of the webinar. If you will consider taking that, I would appreciate it. We have a great prize, a bag of books for that for anyone who participates. Will go into a raffle and hopefully you'll win a great bag of books. And finally, if you're interested in learning more about including the Library Foundation in your estate plans, I'd love to connect with you. My information will be on the last slide of the presentation, so feel free to reach out if you have any questions or want to learn more. And with that, I'd like to introduce our guest speaker today, Nick Foy, who is the founder of Greenway Wealth Advisors. Before founding Greenway in 2018, Nick honed his institutional investment expertise at Vanguard and later opened the Charlotte office for a California-based independent advisory firm. He's a graduate of Miami University and earned his CFP certification in 2010. Outside the office, Nick is deeply embedded in the Charlotte community and has volunteered at the Brookstone School and served on the Family Advisory Council at Levine's Children's Hospital. And there's a rumor that he knows the best nacho places in Charlotte. So you feel free to ask him about all his expertise, financial or nacho wise. So, and with that, Nick, I will turn it over to you.
Thanks, Talia. I appreciate it. And good afternoon, everybody. Thanks so much for being here and joining us for this today. I'm going to go ahead and share my screen. And today we're going to be talking about planned giving, smart giving, and really being strategic about the ways that you can think about giving. And I'll tell you just a quick story or anecdote at the top that we work with about 170 households, mostly from within the Charlotte region. And I will tell you that those clients of ours who are the most dedicated and thoughtful about their giving strategies and who prioritize giving also tend to be those that are most satisfied about their finances. And that's the anecdote that we find. But then there's also a lot of data on that broadly about individuals and families that choose to put giving first and thinking about giving as a priority and the impact that it has not only on the way that they view their own finances and the way that they steward those, but then also generationally, the way they can include their kids and or grandkids as part of the conversation. So today we're just going to look at some high-level basic items to give you an idea of ways that you can think about structuring giving so that organizations benefit more. Ultimately, your family benefits more too. As Talia mentioned, I grew up in California. We've been in the Charlotte area since 2005. And I started my career in personal finance at Vanguard in 2007, and then became an independent advisor in 2011. I was telling my wife the other day that I was planning to do a webinar on planned giving, and she said, "I don't think anyone actually knows what that means." And I thought, yeah, I don't know if I could necessarily define it myself. Her mom used to work in the giving department within the University of Richmond in Virginia, and she'd talk about planned giving a lot, and she'd go to planned giving conferences and that sort of thing. But that doesn't necessarily mean that the rest of us have any idea what it means. So I sort of put a definition of it out here as an intentional, forward-thinking method of charitable support, of supporting organizations that are doing good things. And instead of just donating cash, or if you see the American Red Cross ad come up after a hurricane or whatever other things might happen, it's actually being intentional about structuring your financial planning with your values to create a lasting impact. And we talk about that here, the structured wealth strategy, using your financial instruments, your bequests, trusts, appreciated assets, your beneficiary designations to optimize your tax efficiency and to protect your estate. And there are a lot of tax advantages for doing it. The government, as it turns out, makes it beneficial for us to consider giving in a really significant way. And we're going to talk through some of those structures here. One thing to note, I noted here at the bottom, I'm a certified financial planner professional. I'm not a state attorney. I'm not a CPA. CFPs tend to work really closely with estate attorneys and CPAs in coordinating, the entire structure of accounts and giving strategies and that sort of thing. But to actually apply any of what we talk here, I'll mention it again at the end, it's really important to include those outside professionals who are going to help you think through and plan and prepare the necessary documents and steps in order to maximize the impact that you can make. Foundationally, these are three things that we think everybody needs. These are foundational estate planning documents, and they sort of make up a three-legged stool, the estate attorneys would call it. The first is a last will and testament, and that's the document to distribute assets to your and name guardians for minor children, to appoint an executor. Without a will, somebody in North Carolina without a will dies intestate, and the laws of the state of North Carolina then dictate division of assets, which may not necessarily be in line with your personal wishes. So it's really important to have a last will and testament. Everybody needs one of these. The second is a medical power of attorney, and this is just a way to designate a healthcare agent who can make decisions on your behalf if you're to become unable to make those decisions on your own. And then the third is a healthcare directive, which is also known as a living will, and that's a way to share your wishes regarding life-sustaining medical treatments. Having all of these written down and notarized is so important. And any estate attorney, qualified estate attorney that you work with should be able to put these documents together. And then you want to make sure that they get off to the right people, that be your expected executor, your physician, and whoever would be your medical power of attorney. What we encourage a lot of our clients to use in addition to that, as sort of the next step, is called a revocable trust. And this is basically a legal agreement that you create during your lifetime so that you can have a little bit more control over the way that assets are dispersed. It could be to family members, it could be to organizations, or some combination of those things. We'll see this a lot with clients of ours that have young children. We'll encourage them to pursue a revocable trust in order to control the timing of the disbursement of assets to their children. And so we'll commonly see estate attorneys write them up as, I don't necessarily want my kids, if something were to happen to me before they were age of majority, which is 18 in the state of North Carolina. I don't necessarily want my kids to receive my assets, outright at that time, because they may or may not have the responsibility necessary in order to handle those. And so there are ways to delay the distribution of those assets, and we'll often see estate attorneys write in age 25 for a third, age 30 and 35, or whatever ages you choose, before the distribution of those assets occurs. And it's just a good way to protect not only your estate, but also your children. Now, one thing we know is that age does not necessarily mean a level of maturity in handling money. And so there are other things that you can write into a trust in order to protect the value of the estate and really to protect beneficiaries oftentimes from themselves. Quick story. My mother died 2 years ago, and she had a revocable trust in basically a single account at Schwab. And my sister and I were the successor trustees, and it made the process so easy in order for us to transfer assets to beneficiaries and to organizations that she had written in her trust. Everything that goes into the trust avoids probate, which is something that is really important. Probate can be lengthy and expensive, so you can save time and administrative fees by having a trust. Everything written in a trust is private. It can be easily amended in order to make modifications as time goes on if you need to. It's got protection from incapacity, which means there's a mechanism for management without requiring a court-supervised guardian, and flexibility for charities to direct funds and remainder distributions either to a charity or to a donor-advised fund, which is something I'll talk about in a little bit. So if you do not have a estate plan in place, or if it's been a while since you reviewed it, I highly recommend working with a qualified estate attorney in order to make sure that you have these foundational documents and potentially a revocable trust in place. And then make sure that your accounts are titled correctly. Beneficiaries are set up so that the trust actually gets funded, and it's not just a document that sits out there with great purpose, but not any necessarily weight behind it. I'm going to move and just do a quick touch on tax regulation. I was reviewing the slides here today, and still kind of amazed that this is what the bill ended up being called. But the One Big Beautiful Bill, the OBBB Act, fundamentally changed the tax deductions for charitable giving starting in 2026. The first way that it changed it is for donors who itemize. They can only deduct qualified contributions to the extent that they exceed 0.5% of their AGI, which is a little bit confusing, unnecessarily so. But there's also a cap for donors that are in the highest bracket. So charitable deductions are capped at the 35% bracket, even though the IRS brackets go higher than that. So they've limited the benefit of charitable contributions slightly. And we'll look at ways to make sure that you're thinking most strategically about charitable contributions here. And the first is this: for donors who are 70 and a half or older. So this could be you, it could be a parent, a grandparent, another loved one. The maximizing what's called a QCD, a qualified charitable distribution, is, we think, the number one way to maximize tax benefit if there is the desire to give to organizations like the Library Foundation. The benefit of the QCD is that distributions that come out of a traditional IRA, so this is usually a pre-tax IRA, are totally tax-free if the check is made out to the third-party organization directly. These have to happen within the calendar year. And if you're somebody who is subject to what are called required minimum distributions, which for most people starts at age 73 now, could be up to 75, the qualified charitable distribution actually satisfies your required minimum distribution. So if I back up a second, the basic deal with traditional IRAs is that they are accounts, pre-tax 401ks you might have through work that generally turn into traditional IRAs after you're done working. Those accounts grow on a tax deferred basis, which means everything in those accounts is totally taxable when you start making withdrawals in or near retirement. After age 59 and a half is when you can start doing those without penalty, but with tax. But the basic agreement is that at some point you have to start withdrawing money from those accounts, and so that the IRS and the government can get what they perceive to be their share. And those distributions are taxable as ordinary income. And we see a lot of people who end up in a higher tax bracket than they expect when they're in retirement, just because they have to take withdrawals from those accounts starting at age 73, whether they want to or not. Well, one way to sort of minimize the tax bite and to support organizations that are meaningful to you is to do this qualified charitable distribution. The $111,000 is indexed now for inflation, so it's going to continue to increase every year. And $111,000 that comes out tax-free can be pretty meaningful. We're going to talk through in a little bit ways to think about structuring your beneficiary designations in order to maximize the after-tax benefit, both for organizations and for your family. But even if you are not 70 and a half, be thinking about the qualified charitable distribution, as I mentioned, even for family members, or if you're transitioning into retirement. A lot of times we see this window if people retire in their earlier mid-60s where they've got a few years where their income goes down, and it might be wise to be thinking about ways to add on income from the IRA, and or to use the IRA as a vehicle for charitable giving as time goes on. Second strategy that we utilize a lot of is the donor advised fund. And a donor advised fund essentially acts like a mini family foundation. A lot of organizations have these. Foundation for the Carolinas is a popular one around here. Vanguard has Vanguard Charitable. Schwab has Schwab Charitable. Fidelity has it. A donor advised fund is a way to be more strategic about the way that you are giving. And the way that I consider it is this: that if you have any assets in a taxable account, or maybe you have a rental property or a closely held business, anything with a long-term capital gain, it's wise to strongly consider donating the asset instead of donating cash. And what that allows you to do if you donate the asset is to avoid ever paying capital gains tax on that asset. And so more money ends up going off to the third-party organization. A donor advised fund makes that really simple. And the reason that makes it simple is because it's a single account to receive all of your charitable gifts. So within minutes, you can transfer mutual fund shares, stock shares, ETF shares that have long-term capital gains into a donor advised fund. And if you're itemizing your deductions, then you can get a tax benefit for that. The middle block here, we talk about strategic bunching. And the idea of charitable bunching is just to basically combine multiple years of expected charitable donations into a single year. And it could be a year where you have higher income than you would in other years. Or it could just be that you want in that 1 year to itemize deductions, and you're just going to take the standard deduction in future years. Bringing down the average tax rate over time by using strategic charitable bunching can be really beneficial and can support your giving goals. Once dollars are in the donor advised fund, they can be invested, and those dollars can then be granted out to organizations of your choice over time. And the organization, all that they receive is a check and a letter, and the check says whatever the amount is, and the letter says that it came from your donor advised fund. So they're really powerful, very simple tools to help you consider how to donate assets over time to organizations that are meaningful to you. I mentioned my mom passed away a couple years ago. One mistake that I made was on her traditional IRA, listing organizations directly that she wanted to donate to as beneficiaries, or she encouraging her to do so instead of listing her donor advised fund. The donor advised fund would have been a much simpler place, because all those organizations then that she donated to had to then go and open up accounts, inherited IRA accounts, and it was a long, messy process. So using the donor advised fund as a beneficiary on an IRA is something that we encourage people to consider. We talk about that a little bit more here, about the architecture of your beneficiaries on various accounts. And I list three types here: a traditional IRA, which are generally pre-tax, a Roth IRA, where the growth is tax-free, and a taxable account and real estate, which at the time of death receive what's considered a step-up in basis. And the way we encourage our clients to think about it is for the traditional IRA, if you're charitably inclined anyway, to be the asset that goes to a charitable organization, or at least some portion of it goes to a charitable organization. And you can do this just by listing the organization, or as I mentioned, the donor advised fund, as the beneficiary of your traditional IRA. And the reason is that those organizations won't pay taxes on it, so they get those dollars totally tax-free. Traditional IRAs that go to heirs, like kids or grandkids, they're required then to liquidate those accounts within 10 years generally. And the liquidation is 100% taxable to them at the tax rate in the years that they make those withdrawals. So if you have a Roth IRA, or if you're considering growing your Roth IRA by doing additional contributions or Roth conversions, that's a great asset to give to your kids or grandkids, or other family members, or to the trust to then be distributed to individuals, because those come tax-free. So there's a lot more benefit for a Roth IRA for individual beneficiaries. A taxable portfolio or real estate gets preferential treatment, where it gets what's considered a step-up in basis. So if you paid $5 per share for stock in a company, and now it's worth $10. If the owner of those assets sells them, then they're probably going to pay capital gains tax on those. But if those assets are inherited by beneficiaries, that capital gains tax gets erased, and they can then sell those essentially tax-free. So we think about traditional IRAs, pre-tax 401ks being great for charitable beneficiaries, and Roth and taxable accounts to be better for individual family members, or maybe to go to the trust. For non-itemizers, if you don't itemize your deductions on your tax return, there's now a brand new above the line deduction, which can lower your adjusted gross income, but only if you donate cash and only if it goes directly to the third-party organizations such as the Library Foundation. So above the line deduction, joint filers, $2,000, single taxpayers, $1,000. Again, as long as it's cash and as long as it goes directly to the third-party organization, not to a donor-advised fund. Last thing I'll mention here is just so important to include sort of these three different, we think, professionals within the conversation to make sure that you're applying what I discussed for your unique situation. And the first is a CPA. A lot of CPAs are not necessarily forward thinking. They either need to be pushed to do so, or you need to find one that is. But a CPA that's helping you think beyond just this year and into multiple years and really through the rest of your life, the most tax efficient way to be giving assets either to organizations or to your family. The second is a qualified estate attorney, someone that can draft the documents, the vehicles, including those charitable bequests. And the third plug is a fiduciary financial advisor. So an advisor that's acting as a fiduciary, which means they're legally obligated to act in your best interest, is an important part of this conversation. And what the purpose of having that is essentially to execute on those things that the tax advisor, you and the tax advisor and the estate attorney come up with. How do you make sure that accounts are titled the right way, beneficiaries are titled the right way, and the dollars are invested in order to give you the best bang for your buck. And I mentioned down here that if you choose to or want to have a 15-minute introductory call with one of our advisors to talk more about how any of this would apply to you, our website's greenwaywealth.com, and there's a tab on there that says meet with us, and you can feel free to schedule time with us there. I think that's my last slide, Talia. Is that right? Oh, sorry, you're still muted there.
Yes, that was the last one. So we're going to open this up for questions now, because we figure there's lots of questions when you're learning more about estate planning. So please feel free to type your questions in the Q&A box, and I'll get us started. Nick, if you would talk a little bit about, if someone's never used a wealth advisor, could you talk a little bit more about what that process is and why people should use a wealth advisor? I mean, you talk about it in your presentation, but is there anything else you'd like to add about that?
Yeah, I think that what we see. So my time at Vanguard, I spent about 5 years there. I was working with clients that were self-directed. They were doing everything on their own. And what we find is that people make a lot of mistakes, which is understandable because there is a lot of complexity within the tax code and within investing. And so, having somebody that you are paying for advice, that is hopefully taking time, adding more time to your day and making sure that things are structured correctly, I think is really important. So much about personal finance is about minimizing mistakes. We think of it like amateur tennis, where my ball, if I go play tennis, which I don't that often, but the job that I should be trying to do is just getting the ball back over the net and not necessarily trying to hit winners. Because when we try and hit winners, we tend to be making a lot of mistakes. So having somebody that can walk you through minimizing the number of mistakes that you can make is a really important thing, and a good wealth advisor should be doing that.
And what age would you say? I mean, probably starting earlier is better, but is there an age when you're starting to really think about estate planning that like, is it when you have children, or when you kind of hit midlife? Is there a specific time that you would recommend?
Yeah, that's a good question. So I mentioned when we look at the three-legged stool of those things that everybody needs. So that is from at any time from age 18 on, everybody should have a will. Everybody should have a medical power of attorney and healthcare directive. They're relatively easy to get now too, relatively inexpensively. There are a lot of online tools that can help with that and at least get those foundational documents in place. The complexity gets added as the balance sheet grows, right? So as the balance sheet grows, or if there are specific needs, or might have a child with special needs or some other thing, and you want to be able to protect them, adding in more complex estate planning tools can be really important. And then the reason we recommend people at least review it every 5 years or when changes happen. So you might move states, and you might have one of your children that becomes age of majority. Whatever those things are, they're like big life event changes, and reviewing the estate plan to make sure that what you wrote down initially is still what you want is a really important thing.
Can you talk more about revocable trust? How easy or complicated is that to set up?
Um, they're relatively easy because most estate attorneys are using a format that they have, and it's asking how exactly do you prefer that those dollars are distributed. It's obviously morbid to have the conversation, and also totally necessary to say when we think about people setting up in any part of their estate plan, the question we should be answering is like, what happens if I die tomorrow, right?
Mm-hmm.
What do I want to have happen? And the benefit of the revocable trust is it's so modifiable over time, so that you can say, oh, things have changed 10 years later in my life. And what I thought I would want to have happened, I can now amend it and make modifications because I'm in a different place as far as finances go, as far as family members, whatever other like personal items that may exist out there. So the revocable trust is relatively easy to set up. I think it's really good, and I'll send some resources out to you also, Talia. I mentioned that to think about before you walk into the estate attorney. What are those values that you want to pass on to your kids and your grandkids, or to whatever family members are involved in receiving the dollars? And the reason I say that is that what tends to happen when people walk into the estate planning office is the estate attorney says, well, what do you want to have happen with your dollars? And they'll say, well, what do most people do? And that's not probably the best question to be. It's really figuring out like, how do I be intentional about passing on values to those places and people that are most important to me, using money as a tool to do that. And a revocable trust can be a really powerful tool to accomplish that.
So when you're talking about that, and another tool that you mentioned was the donor advised fund. Can you talk a little bit about how, when a donor sets that up, how they can define what those funds are used for, or leave it open-ended, and how does that work for the heirs to an estate? So what happens with the donor advised fund?
Yeah, sure. So with the donor advised fund, you can list on there. They call it a successor trustee, I think is the name that they use. But anyway, there's a successor person that you can list that basically has control over the distribution of those assets. And you can also list within it organizations that you want the dollars to go to. And so it's usually on a percentage. It could be on a dollar amount basis. You could say, all right, I want at the time of my death, I want my sister to be in charge of distributing these assets, and these are the organizations that I want any residual dollars in the donor advised fund where I want those dollars to go. Anything to that point, I mentioned beneficiaries earlier. Anything that you have that can pass by contract, meaning you have a contract with the organization that actually supports that account type, we think is really important. So the contract with Schwab Charitable or Vanguard Charitable or Foundation for the Carolinas for the donor advised fund, or the contract with your custodian. It could be Merrill Lynch, or it could be Wells Fargo or Schwab, or whoever you use. The contract that says those dollars are going to get passed to the beneficiary by this organization. For dollars that you own, it means that they can avoid probate by listing those. And for the donor advised fund, it just means a really simple way to make sure that those third-party organizations receive the dollars, because that's the contract that you had made at the time with the organization that sponsors it.
And then typically, do you find, so if you did not have heirs that you were going to pass a donor advised fund to, so that you've set up your donor advised fund and it's to benefit literacy organizations, then at that point, the organization that's managing that, whether it's Vanguard or Foundation for the Carolinas, do they then look for beneficiaries that fit what you've set it up to do? So even though you don't have an heir that is gets to choose, that you've got, they are still using your funds as you set it up to do.
Yeah, and it's good to list specific organizations with it, I think. But you can do that. Yeah, you could say that any residual dollars at the time of my death, that they automatically get sent out to whatever those organizations. So I'd be more specific than just saying places that are literacy-based organizations,
Mhm.
and say it's the Library Foundation
Mhm.
or whatever other third parties you're interested in. But yeah, that is a possibility.
Okay. Um, What do you say if someone is looking, they're wanting to get started? Do you think it's better to start with a wealth advisor and then work with an estate attorney? I know you work closely with estate attorneys, but what would you say the first best step would be?
There, obviously, I have a bias in this. I think having somebody quarterback the process so that you can get referred to people that are a best fit for you, right? A good financial planner should be quarterbacking the process of including those outside professionals that will add the most value for you. And for us, generally, it is a estate attorney. There's insurance planning involved, a lot of times life insurance, liability insurance that's involved with it, a tax advisor, and so having somebody that is integrating those outside experts is a really sort of like having a contractor when you do a renovation on your house, right?
Yeah.
And you hire a contractor because they're going to bring in whoever the outside, they're going to bring in the electrician and the plumber
Mhm.
and the and the framer and everything else in order to make sure that the house gets gets built most efficiently, hopefully, and in the best way. And it's a relatively similar process that a good financial advisor should be doing for somebody.
Great. I'm going to give everyone one more chance to type in any other questions. And while I do that, one other question I had for you is, what do you think is the benefit to having a wealth advisor that's local to you, that's in your community versus one that you may be connecting with online?
I think it's a matter of comfort as much as anything. Our clients a lot of times like to come into the office, and we
Mhm.
like to have them here. So I think that's great. Some people it doesn't necessarily matter as much. I think what you should be looking for is someone that can provide accountability as much as anything else. So we'll sit down and have a long conversation with people about what their goals are and what their values are and what's important to them in life. And then a couple of years later, they might get off track a little bit and call us and say, oh, I'm going to spend $120,000 on a Rivian. And we'll go back, we'll say, well, at the beginning, that wasn't really what you wanted to do. Is something changed about what your goals or your values are? So those are fun conversations to have. But I think the best way that people can be provided accountability, we talked about this idea of stewardship, and it's the idea of like acting as a trustee and not as an owner, even of your own assets, is really how I'd consider stewardship. And for a lot of our clients, they're acting and stewarding assets for their future selves, and stewarding their balance sheet and their cash flow for their future selves. It could be for their kids or grandkids or for organizations. And people that do that, tend to have more success when you think about, let's just pretend it's not mine. So I would say, like, however you are provided the best accountability towards that, and it could be local or it could be somebody who's remote. There are really qualified people that do things both ways. So
Great. We have another question here, which is, do you have to get a new trust if you retire in a different state?
great question. Generally, yes. Not always. Sometimes they can be amended and sometimes they have to be restated. So it's a good question for the estate attorney, and it depends. Like every state has different laws about the way that that their estate plan will work there. And so I'll say generally yes, but not always. So if you move to North Carolina from somewhere else, what we tend to see as estate attorneys, they do what's called a restatement of the trust, which is basically a clean slate, bringing it in and making sure that everything applies based on the current laws for the state of North Carolina.
Great. All right. Well, I'm going to share the contact information here again. So if you, Nick, thank you so much for your time and your
You're
expertise.
welcome.
We hope that you have found this helpful and inspiring. And I am going to email Nick's slides, a list of resources, and the recording later this week. So you'll have all that information to review. If you have not, once we get off this webinar, if you will consider taking the survey, we would appreciate that, and you'll get entered into a drawing for a bag of books. And as you reflect on your own giving, please consider including the Library Foundation. And if you already have, please let me know so that we can ensure that your wishes are honored. Again, thank you for joining us, and I hope you have a great rest of the week.
Thanks, everyone. Thanks, Leah.
Thank you.